Jeremy, how do you look through the noise, or do you not?
Well, it looks choppy to me, and I think you named those two things. I mean, tariffs I had, and the question of AI spending. Now, we've had some firms reaffirm their spending, but things can change if fast-moving developments show that the need for high-level chips is not what it would be before. Now, we had a nice bounce today in NVIDIA, but clearly, I think those two uncertainties seem to me to put a cap on any big thrust in the market in February.
Of course, looming all over this is really what's coming out of Washington, or at least the anticipation of what could come. And I know we sort of had a taste of this a few years ago during Trump's first term. This feels a little bit different. There's a lot coming out in a relatively short time, just a couple of weeks here. Do investors, do they just sort of sit and wait, or is there sort of a way to sort of navigate through this?
Well, I mean, we saw the first time, I mean, he stepped back at the last moment, which really didn't surprise me, but it's like the wolf, the sky is falling, the sky is falling, and pretty soon people are going to ignore it, and maybe he will put them on, and that sort of uncertainty is always in the back of your head in terms of what kind of strategy he will have on the tariffs. You're absolutely right. It is much more aggressive now than it seemed to be in his first term. And I think that that's an uncertainty that, the stock market doesn't like those uncertainties. So it's going to discount them and keep it from moving higher, even though earnings certainly look good in the fourth quarter.
What's so interesting to me is just a week ago, I was at a hedge fund conference, and the vibe was buoyant. I mean, you could just sense that the U.S. exceptionalism theme was running rampant. Everyone was feeling really good, and that has obviously changed now, just like a week later. Does it change again? Like, how do you manage that kind of turn?
Well, I think long run, U.S. exceptionalism is still there. And I mean, the Mag 7 is a unique group of stocks such as we have never actually seen before in history. I mean, a group of trillion-dollar stocks which have earnings backing them. I mean, except for Tesla, we're talking about PEs in the 30s at most and some below that. So the group of earnings that they have is also unprecedented in history. Mm-hmm. And so there's very little to know when that trend will stop. Clearly DeepSeek is one threat, but as I say, a prize fighter, takes one blow, he keeps on fighting. Mm-hmm. Normally, for a narrative, a trend to change, you need 2 or 3 factors that convince people that, hey, you know what? I think it might be time for a rotation. But we all know how many head fakes we've had about rotation in the last 6-9 months. 1 or 2 days of bad tech, and then it comes roaring back. So, yeah, I mean, in my look, the trend is still intact. But certainly we've seen some softening in the last 4 weeks.
Yeah, it's so true. It's like just ask the small caps, one day one thing, one day the next thing. So U.S. exceptionalism plus AI, that's there. And the other bucket, though, you have many looking for an expansion of earnings and a rotation within the market and a sign of a healthy market. What would tell you we're in a healthy market?
Well, and clearly, I think what was hoped to have happened was that the Fed was going to lower those short-term rates more. And that does help those small and medium-sized stocks a lot. And when the realization that, we might get only one or maybe no cuts this year, interest expense is much greater proportion of earnings for small and mid-size than certainly the Mag 7 has virtually no interest expense. All capital, all equity. So I think that, that hope that many expressed when the Fed did the 50 basis points cut in September, has basically been dashed by the strength of the economy, the threat of tariffs, the sideways movement of inflation, and therefore the tremendous revision of what is going to happen to interest rates from what we thought 4 or 5 months ago.
Yeah. Well, the good news, at least in the secondary market, you're seeing a big drop in yields today, not necessarily for the right reasons, Jeremy, that 10-year down about 9 basis points right now. I am curious about the impact of the dollar, because we've heard this come up on several conference calls and earnings reports so far this season, that headwind is real and is having a material impact. And if this trade war continues, the theory is that dollar appreciation will be the story.
And you're absolutely right. First of all, tariffs would bring about a rise in the dollar, and it's already brought about a rise in the dollar. 41% of the revenues, and I even think a slightly higher percent of the profits of the S&P 500 come from foreign sales. So a 5 or 8 or 10% rise of the dollar, if you really take the broad one, that really does nick the dollar value of those sales, and certainly is going to be a headwind coming forward. Even without the imposition of tariffs, the high dollar, I think, is going to be a headwind for Q1 earnings. Of course, we won't have those until April, but it's certainly just something to contend with in 2025.